You're a 63-year-old married couple and you've got $250,000 of income. And you may be asking yourself the question, with all the talk around too much spending and taxes, what will be the impact to my income if the Trump tax cuts expire? That's what we're going to look at in our video today. Hello, my name is John Vandergriff. I'm one of the owners and the wealth planning team lead at Blue Ridge Wealth Planners, where we help people answer planning questions about their retirement. And one of those that we're paying special attention to and have really ever since the Tax Cuts and Jobs Act started in 2018 is the impact if that tax code expires and just reverts back to the way brackets were in 2017. So I want to show you some impact of that with an example here today, but really how you apply this to your specific situation is what matters. So if you really haven't had much of a conversation with anybody about tax strategy, click the link below our video. We'd be happy to set up something, but let's go into our topic today. So $250,000 of taxable income, and we're going to look at this purely from a federal income tax perspective. I know a lot of you out there may have state income taxes. You may even have city taxes depending on where you're living, but we're just going to look at the impacts federally here if those brackets do change. Again, for a married filing jointly couple here that are 63 years old. 63 isn't necessarily the important factor here. The main thing that changes, if you reach the age of 65, you will have a higher standard deduction than everybody below 65. So we're just using the standard deduction for everybody under that, which is why the 63 age is important. So as we look at this, the Tax Cut and Jobs Act is what the technical name. A lot of people will refer to this as the Trump tax cuts, or Trump tax code is what some people use. It is set to expire if nothing changes December 31st of 2025. So January 1st of 26 would start into an environment where the brackets will return back to the way the brackets were in 2017. Now, obviously, there will be some adjustments for inflation. We don't know what future inflation looks like, so I'm going to show you what those percentages will look like in today's money, and this is using government's inflation data, so this is not figures that we've made up, but using the standard deduction now plus the brackets as you progress through them, which is the way that we think about our income normally, because most of the time you don't think about your standard deduction as free income, but really it is. If you itemize, then that number could be higher than that. 2017 brackets, you'll see that you've got some similar numbers here. We have adjusted these income thresholds though by the increase from 2017 to the beginning of 2024. So this is inflation adjusted at least from January of 2017 through January of 24. And what you will notice just side by side, there's not a huge bit of difference in when you progress to the next tax bracket, except in the 28% bracket, you've got about $100,000 less before you jump up to the next bracket. So more dollars in that 32, or what we would see 33% bracket. We're not going that high in our example today, but for those of you that have higher income, you could have obviously more impact looking at the things that we're looking at today. And then obviously the 35% bracket goes about $140,000 higher. Top brackets are different. So again, side by side, you see some brackets that have no change. You have some brackets that, even though it doesn't seem like a lot, the 12 to 15 is a 25% tax increase. So again, pretty significant as you look at those dollars, and we're going to see that reflected with the money that you have. So what we're assuming here is you have $250,000 of taxable income, okay? So whether that's wages, we're not factoring in your FICA taxes. If this is retirement income, this is just your taxable number. How does it progress through the federal tax brackets here? So as we looked at, your 0% bracket is your standard deduction, so there's no taxes owed on that first $29,000. Your next bracket at 10% is roughly $23,000, so you've got 10% of the taxes there. 12%, you encompass the whole 12, so there's 12% of the $71,100. 22%, again, 24%, which is the remainder of the $250,000, and then the roughly $230,000 that the is the top of the 22%. So that's why we're not seeing a huge number there, but it is obviously 24% of that 19,000. So if this was your situation today, 250,000 of taxable income, as you progress through those brackets, your total amount of tax would be $39,077, or a 15.6% effective tax rate. Because like we said, we have to understand that our tax environment, our tax system is a progressive tax system. You're not taxed all at 24% because you progress to that at your top dollar. You pay it as you go up through these brackets. So again, as you went up, 15.6% tax rate. How does that compare to if the tax code expires and we return back to 2017's brackets? And again, in 2026, these numbers could be different, but we're using them for the inflation factor for 2024. So as you see here, the same thing for standard deduction, 26,000, no taxes owed. The 10% bracket at that time would be roughly $2,300. Then we see the 15% instead of the 12 be at 10,800, 25% instead of 22, 25% of 97,000 of your income, and then 28% on 30,000. As we see that reflected down, your total amount of tax jumps from a little over 39,000 to a little over 46,000. So about a $7,000 increase, almost to the dollar, which as a percentage of your 250 is 18.4%. So you say, okay, well, going from a 15% tax rate to an 18% tax rate doesn't sound like a huge difference. Well, let's look at it from a few different ways, okay? So the first one is if we do the math here, this is the under 2017's brackets, this is 2024. You see that, like we said, almost $7,000 to the dollar, $6,999. If we take that as a percentage of what you're paying today, that's an increase on your amount of taxes you're paying of almost 18%. So again, on your income, nothing changing other than those brackets, the amount of taxes that you are paying goes up almost 18%. So pretty sizable when you look at it from that perspective. The other thing that's interesting is we look at this. Let's say you're in a position where the $250,000 of income that we're talking about is your wage income, and you're maxing out your 401k now and deducting that amount to be able to get to $250,000. So really, because you're over the age of 50 years old, your maximum contribution to your 401k is $30,500 with the government limit plus your catch-up of $7,500. So if we look at this and you say, well, if taxes are going up almost 18%, does it make sense for me to switch those contributions from a 401k to a Roth 401k? Let me show you what the math looks like. So if we take the $250, and again, assuming that you're paying taxes on this income at your top tax rate, you would add $30,500. Instead of making it to where you get a deduction in your 401k, you go ahead and pay those taxes. You will notice that the tax owed on this is $7,320 for that all to go into the Roth bucket, and that money to immediately start making tax-free growth from this point forward. And so as we look at this, going back to our numbers, if you were to add $7,320 to the taxes that we had for this year, $39,000, you would notice that paying every bit of taxes here only cost you $321 more than what your taxes would be in those 2017 brackets. So essentially, that's a big enough tax increase to where you could pay almost all of the taxes on your contribution to your 401k, going instead of a deductible bucket to a bucket where you pay those taxes and then you get tax-free growth on that money moving forward. And if you're not working, maybe you look at that from a standpoint of conversions. It's the same thing where if we add $30,500 of conversions, again, you're going to have the same tax result and just be a little bit higher than you would be if you did nothing and kept your income exactly the same. So as we look at this, this is why tax planning is important, to really try to help you preserve and make good decisions with your money, because obviously we can't control what happens in these tax environments. We can't make the government have less increase than they want to. Obviously we can vote and try to have people in office, but if there are some things happening, and I think the amount of spending that we have today and Nobody's real concerned about the impacts that that's going to have long-term. Things like Social Security are going to catch up to us, and it won't matter which side of the aisle gets caught with what I call the hot potato. Somebody's going to be forced to raise taxes at some point, and if that happens, the question becomes, are they going to stop at 2017's limits, or could they go higher than that? Because again, we've seen taxes be noticeably higher than where we've seen going all the way up to a top bracket, instead of 37% as it is today, all the way up to 94% just after World War II. So as we look at this, we want you to pay attention to this. We want to see how this can impact your life, not just in the tax buckets that you have, but also how that trickles into investment management, income strategies. All these things are connected, which is why you need to have a well-rounded retirement strategy. So if nobody's talked to you about taxes and how to strategically use your money to allow you to pay hopefully the least amount of taxes possible, we'd love to do that. As I said, click the link below our video and we'll schedule a time where we can talk to you about your situation and how we can potentially help you make some decisions that may pay some taxes now, but avoid paying maybe more taxes in the future. So hopefully you learned some things. If you have any questions, please leave us some comments below. And yeah, we look forward to talking to you later and giving you more content like this in the future.